what we were discussing towards the end is something very interesting, and let's just continue that discussion. So we were saying that Carhart model is a factor model, and we said that there are different factors that we can look at, and if none of the factor is working, then the excess return, which is RP minus RF, could be given by intercept, right? And then we said that there are different sensitivities to it. This factor RM minus RF explains the risk-free return, the return over the risk-free rate or the treasury bills.
Yeah.
While this SMB, which is small minus big, represents my size.
Yeah.
This is a size factor. HML, which is high minus low, is the value factor.
Yeah.
And एक और था ना, हाँ ये रहा. So W minus L, which is winners minus losers, shows the momentum factor. Okay. And then we also said, I wrote over here, momentum factor. And then I said that depending upon how the sensitivities are, if it is -1, if it is 1, if it is 0.5, it is 0.3, we can say how the portfolio looks like. And then when we did the question, we realized that while my portfolio, the benchmark, while we said that my benchmark has a sensitivity of 0, and the only thing that I was sure about that this is not a treasury bill benchmark, and it looks like that it's a large cap, but I would say it's a large cap blend. I'm calling it as a blend because I don't see anything major in any of the sensitivities, while this was a value large cap value tilt. Okay. And then we also saw at the end that the only contribution, the major contribution that was given by the value tilt, which was around 78%. Now,
total,
which is 1.29 has been derived from 1.29 divided by 1.65. I guess so. यही होना चाहिए.
Correct.
ठीक है. 1 point. If you do, let me quickly do that. If you do 1.29 divided by 1.65, you should get 78.01. This is 78%.
Yeah.
Yeah. So the idea here is that they're trying to see from which component does the maximum return is coming from. One thing I also want to tell you is, obviously when you see the question, how they can ask is that they'll tell you that the manager is this and that, and they said that the company is doing, the market is doing really great, all the IT firms are progressing a lot, and the manager also thinks that he is a growth investor, because he wants to invest into IT companies or a small companies or a growing companies. So he's a kind of a growth investor, and then they can give you this question and could ask you, is the manager view or the call is right or not? So the point I'm trying to make is that you understand from this that the portfolio is a value tilt. So if the manager is saying that he has an expertise in growth tilt, while the portfolio says it's a value tilt, so it means the manager's call is all wrong, and whatever he's doing is not in line with what his expertise is.
Got it.
Okay. All right. So this was about Carhart model. Now let's just start with fixed income. So so far we have covered basically equity, return, attributions, and in that we talked about BHB model, right? And then we also about BF model. We understood where the problem was and how did we fix it. We discussed that in detail. And then we also talked about a factor model. Okay? So these were return-based models. So far, so good?
Yeah.
Okay. Now, when it comes to fixed income, there are again three type of models that we can think upon. One is exposure decomposition. Again, it's just a name. Obviously, I don't expect that in the exam they will ever ask you about the name. Ever. Any question that they create will be on the analysis of the attribution, but not that, okay, if this is the attribution, which kind of attribution it is, right? So you're not going to get any question on that. Okay? But the idea here is that one is exposure decomposition, which is duration based, and we'll talk about this in detail. Another one is, they call it yield curve decomposition. Again, it's a duration based. And last one is yield curve decomposition, but a full pricing based. I'll tell you what the duration is.
Second one is what?
Yield curve decomposition, but duration based.
Okay.
Okay. So this is exposure decomposition, which is duration based. These two are yield curve decomposition.
Okay.
But this one is duration based, this one is full pricing based. So we'll talk about why duration based and how does it work. So one thing is, I hope you know that whatever we do on a fixed income has more to do with duration and convexity. Convexity is just the double degree of duration.
Yeah.
And duration explains a lot of things, right? Because in fixed income, it is all about the yield curve. Okay. So they say that how can I generate? Actually, one thing that I want to tell you in fixed income is we calculated a lot of numbers in equities while we are trying to do the attribution. But in fixed income, you will not be asked to calculate any number. It's just that they give you numbers and you need to interpret those numbers. Right? So they say when it comes to, I'm talking about this one now. So they say that how can you generate additional return or active return on fixed income? So one of the studies that they say that you can play around with duration, right? Let's just talk about this. How do you think that you can play around with duration and generate active return? Any idea?
You again play with the weights compared to an index.
Sorry?
Weights compared to an index.
Weights, okay. ठीक है, weight तो है. लेकिन when I say duration, it means obviously you will have some kind of a short-term duration bonds, medium-term duration bonds, and then long-term duration bonds.
Yeah.
So my question is that can you play around with duration and try to get active return based on some speculation? So I'll help you with one. Let's say when yield curve goes down, can I say yield curve is going down? It means interest is going down. Is that correct?
Yeah.
Okay. When interest goes down, and we know that interest and price have an inverse relationship.
Yeah. Yep.
If interest and price are inverse relationship, and you know how do we calculate NPV? We do coupon upon 1 plus I to the power n, right?
Yes.
So basically C1 upon 1 plus I plus C2 upon 1 plus I square plus C3 upon 1 plus I cube, and then Cn upon 1 plus I to the power n. Right? So can I say that the longer maturity bonds, basically think about this, I'll give you an example. That let's say a coupon is fixed and interest rate is 5%, right? So this is 1.05 and this is C upon 1.05 to the power 10, right? And then the interest rate became 4.5. This becomes C upon 1.045, and this becomes C upon 1.045 to the power 10.
Yeah.
Don't you think that it has much more impact than this? Yes or no?
Yeah, it does. Yes.
So if I call this as A and I call this as B and I call this as C, at least if we compare these two for now, right? The B is the B is smaller or greater than C.
The B is greater than C.
B is greater than C. कैसे? ये तो 1.045 है, ये 1.05 है.
You mean the denominator or the entire thing?
The denominator.
The denominator C is greater than B.
ठीक है? So I'm saying when there is a reduction, the reduction will be amplified by to the power 10.
Yes.
So this overall, when you discount it back, the increase in the price is much more. So the point I'm trying to make is the point I'm trying to make is
correct.
Long story short is that if you are investing into long-term bonds, basically long-term as in duration. If you are investing into long duration bonds, let's say 10 year, 15 year, 20 years, which means that the change in the interest rate has a high sensitivity. Why high sensitivity? Because of the to the power.
Correct.
Right? So a small reduction in the interest rate will have a huge impact on the price. A small change in the interest rate, a small reduction in the interest rate will have a huge change in the price, and hence buying a long-term bond, if I think that the interest rates are going to go down, would lead me profits.
Yes.
Okay. But before saying yes, let's just see and put some random numbers to it. Again, calculation is not required so that you would remember, right? So I'm saying, let's say you bought a 10-year bond and it has a value of 95, for example. And at that time, the interest rate is 5%. Right? And then the interest rate goes to 4.5%. So you can imagine the price would around, let's say 96. Can you say that?
Yeah.
If the interest goes down, the price would increase.
Yeah.
I'm just putting some random numbers just to give you the relation. So if at an interest rate of 5%, if the price is 95, if the interest rate goes down, the price would increase by something. Right?
Correct.
But when it is a long duration bond, the impact is even higher, which means the price would even go 98. So you bought at 95, the new price is 98. Had you bought some short-term bond, the price would have increased from 95 to 96. But for a longer duration bond, the price increases more. Why? Because the sensitivity is high, because that's a to the power. Does it make sense, or are you able? If you're not able to relate, we can always solve a question. No,
I'm able to relate.
Is that clear?
Yes.
Right. I'm perfectly okay if you want to stimulate some numbers on a dummy.
This is well understood.
This is clear, right?
Yeah.
Okay. So they say how can we earn more active return is that if I speculate, if I believe that the yield curve is going to shift downwards, right? Then I can go long on a, or maybe I can buy simple on a long duration bonds. Does it make sense?
Yes.
Another thing is, this is duration. How can I play with duration? This is how I can play with, and obviously the opposite is also true. So if I think that the yield curve is going to shift upwards, then I go long on a short duration bonds. Okay. Another one is curve shape. So one thing is that you have a yield curve and you see parallel movements. This is called parallel movement with respect to this. This is parallel and this is parallel. Right? So when I was talking about duration, I was referring to parallel movement. But there's another thing which is curve shaping, which means on the same duration, let's say you have this before and you have this. So can I say that versus now you have, can you see? So I haven't increased the duration. This time the duration, this is a short-term bond, this is a medium-term bond, and this is a long-term bond. So I'm not really extrapolating this line. Extrapolating this lines means that I'm moving from a short-term to a long-term duration bond. But I'm saying, let's say I have a bond of this duration, but within this duration, there is a steepening that happened. Steepening. You see that?
Yeah.
So obviously that could also happen in the yield curve. When can this happen? This can happen when the short-term interest rates, let's say, increase by 10 bips, but the medium term or maybe long term, whatever, I'm just assuming the curve is still the same, the duration is still the same. But in the short run, short-term bonds increases by 10 bips, but long-term interest rates increases by 50 bips. Can you see? From this level to this level, from the original level, this will become something like this.
Yeah. But in this, the duration, correct.
Right? So this movement is still the same, because this distance is the same.
Oh.
So I'm not playing around with duration for now.
Got it.
Yeah, this is still the same. I'm not playing around with that, but I'm saying it has steepened.
It has steepened, yeah.
Right? So this is 10 bips and this is 50 bips. Right? So they also say that I can play around with duration. Right? Actually, this is not the right way to create it. But to say that, okay, this is the curve and this is like my parallel movement. I can say that I can go long here.
Yeah.
And when the interest rates go down, then I can earn. This was on the duration. On the curve shaping, they say that I'm not really playing around the duration, but I'm saying for whatever duration bond that I can see, if the interest rate changes for a short term and a medium term bonds differently, and basically the idea is that the movement is not parallel.
Yeah.
Right. And then I can also say that it could be flattening as well. Steepening is one of the ways. Flattening is another way. So this was original. So either it could go this way, which is steepening, or it could go this way, which is flattening. Ultimately, it is playing with the shape. Right? So the point is that if you think that the curve is going to steepen, then again you believe that interest rates are too high here.
Yeah.
Right. So the price could be lower. So if you think that the curve is going to steepen, you buy short-term bonds. Right? And then maybe you sell long-term bonds. So think about this. You sold long-term bonds today when the interest rates would go high, the price will go down. So basically you sold expensive and then it becomes cheap.
Can you repeat this? Sorry.
I'm saying that the question can come either way, right? And then you should know how the dynamics is working. So I'm not really saying that you should only do one thing. So I'm saying either you can buy short-term bonds, or maybe I'm saying if you have a long-term bond already, right? So you sell if you speculate that the yield curve is going to steepen.
You sell it, yeah.
Yeah, so you sell now. You sell now, and when the yield curve steepens, basically interest rates goes up, price goes down. So you are effectively selling expensive and maybe buy later cheaper.
Okay.
Again, the idea is that you want to earn somewhere in between, right? So you take a decision before the movement, before any kind of, let's say you think, and when this usually happens when you have Fed interest rate, right? So how it works is usually steepen happens when let's say the Fed says that the interest rate is going to go up by 10 bips in short term, right? So people speculate, the retailers, the investors, they speculate. By the way, do you know that increasing the interest rate is a expansionary policy or a contractionary policy?
Contractionary.
Okay, so we understand.
Yeah.
So the investors, they speculate that the Fed is increasing the interest rate. It means the inflation is going to come. Is that correct?
Yeah.
So they believe that if the RBI, or basically the Fed, if they are increasing the interest rate, it means they are speculating, because they every target, right? They do it for future. So when they are thinking of increasing the interest rate, it means the inflation is going to increase, which means their purchasing power, the purchasing power will get eroded. So they would want more return to hold the longer maturity bond, even more return, which is being represented at yield.
Yes.
Right. So basically that steepens a lot. So it's not a parallel movement. It just steepens because the people believe that inflation is going to come and my money will get eroded at much higher rate. So I want more return so that I can compensate. Okay. So I gave you this background, but that's not really relevant here. The idea here is that if you see the curve is steepening, then you can sell today, and when the interest rates increases, you can buy then, and accordingly you can play around, or maybe you can just go long the short-term bonds. Okay. All right. I am doing all of this discussion so that you get any question, you can think in that direction, because we don't know how they're going to frame the questions, but it is going to be somewhere on these lines only. Third one is, again, let me just keep making note of the different things that we have discussed so far. So one is, we talked about that let's just play around with duration. Second, I said do something in terms of curve shape. Third is sector selection. Okay. Achha. How about this one? You have two type of sectors. Let's say you want to talk about corporate and government. You have corporate bonds, you have government bonds. Now, if you think that the market is going to perform better, will the spread between these two reduces or increases?
What? Sorry, can you say that again?
I'm saying if you believe that the market is going to perform better in upcoming times, obviously we are everything that we are doing, whether in terms of duration curve shaping or and something else, we are deciding today and we are speculating for tomorrow.
Yeah.
Right. So if we think that the market is going to do well in future, do you think there is a difference between the corporate and government? Basically, the spread is going to increase or decrease?
It is going to decrease.
Decrease, right? So, and I hope you know the reason.
The reason is can you just tell me the reason once? Like, is because corporate credit is then assumed to be safer, or the base rate increases because of inflation?
Okay, I'll tell you, and you will understand this even better. In good times, when the markets are doing great, do people invest more in small cap or large cap?
Small cap, like they can take on more
small
risk.
Cap. Okay, we understand this, right?
Yeah.
When the market is doing great, we invest more in small cap and less in large cap. When the market goes haywire, we tend to invest more in large cap and we extract money from small cap. Okay. Why is that so? Because when the markets are doing well, I know that small cap is going to outperform my large cap, right? And since the risk is less, the spread between this decreases. Why do we say? Think about this. When I say excess return, what does that mean? It means RP minus RF. All them telling in terms of equity, but the idea is the same, that I am trying to get the spread with respect to something which is risk-free. Right? Now, if I believe that the market is not performing well, in that case, I would want more return because I'm taking more risk. When the market is not performing well, then there are high chances that that product in which I'm investing will not perform well.
Yes.
But I'm still investing in that product. It means I'm taking a lot of risk. It means if you're taking a lot of risk, you want a lot of return, isn't it?
Yeah.
Right. So more risk, more return.
Yeah.
Right. So it means you would want more of RP.
Yeah.
While the risk rate is still the same. So the spread widens. Isn't it? देखो, on an efficient frontier, right? You are only being compensated for the additional risk that you are taking.
Yeah.
And that's why they say if you can diversify away risk, you are not being compensated for that return. For any kind of unsystematic risk, if you are taking that, you can diversify away. Think about this. You said that I am buying 1,000 shares of Infosys, so I have a concentration risk. I want more return. किसने बोला लेने के लिए? I never asked you. It's just an unsystematic, specific risk, company-related risk. That's your problem. I'm not going to compensate you.
Yeah.
Right. But then if you're going to diversify away, but then the market itself is risky, then yes, you will be compensated more for that return. Okay. So I will not go into detail because these are level 1, level 2 concepts.
Yeah.
But the idea here is that if you're taking more risk, then you are eligible to get more return. And when are we taking more risk? We take more risk when the markets are not performing well. Okay? So if the markets are not performing well, you want more risk, basically means more return, and then the spread widens. Now, apply this exact same logic in terms of corporate and government, where government represents here T-bill and corporate represents your RP. Okay? This is risk-free, this is risky. So when I believe that the markets are doing well, when the markets are doing well and the chances of defaults are low, I would want to invest into corporates more. But when I believe that markets can crash and might not perform so much great, then I would want to invest into government bonds. So I'm saying, depending upon the speculation of how I perceive the market is going to perform in another 1 or 2 years, I can go long on corporates or I can go long on govies. ठीक है. So मतलब मुझे लगता है I have spent half of my career into fixed income.
I see.
ठीक है. तो मतलब my day in day out was more about IG and HY and then corps versus govies. ठीक है, जितने भी इनके products आते हैं, whatever it is. So I'm saying that I could clearly see what I'm trying to tell you now. मतलब that how the spread works, right? How HY performs versus IG, and the thing that I'm telling you in terms of corporate versus government, the same analogy works for IG versus HY within the corporates. So if the market is really performing well, I would rather go ahead and invest into HY and not in IG. It is as good as small cap versus large cap. Can you see that?
Yeah.
Okay. Again, the idea is that I can also play around with sector. And lastly, you can have a bond selection. Okay. This is like very specific, that you do the present value, etc. If you think that something is under, what do we say, undervalued, right? Then you can always go long on that. Something is overvalued, that you can go short on that. Okay? Are we okay with the 4 factors of how you can generate returns?
Yeah. Yeah.
Okay. So coming back to this was more about how can you generate the active return. Then coming back to the decomposition duration method. So what it says is the name represents duration decomposition. Right? So it says what it does is it actually breaks down my portfolio into small duration, medium duration, and then long duration bonds. Right? And then within that, in each of these, we represent how much underweight or overweight and maybe sector. And then we do the same for benchmark. Right? So we look at overall our portfolio. Then I'm going to segregate my portfolio in terms of, because my portfolio will have different kind of bonds, short-term bond, long-term bond, medium bonds. And then I'll also have some kind of within those short-term, medium-term, long-term, I'll also have corporates and govies, right? And I would have, with respect to the benchmark, obviously I would have some done overweighting and underweighting in those things. So it says, let's just create buckets, and hence the name explains duration decomposition. I'm going to decompose my whole portfolio in terms of small duration, medium duration, and long duration, and that within that sectors, govies versus corps, and then I'll do the same with the benchmark, and then I'll compare.
Yeah.
Okay. All right. So let's see this. There's a good analysis that they have done. Okay. Looks like a lot of data. Okay. But let's see if we can figure out at least something from what's given, and then we'll see what are different key takeaways. Let's just try to see what they are first of all. Can I say this is more of a portfolio thing, and this is benchmark, and this is again portfolio, and this is again benchmark. So why 4 tables? So this is with respect to duration. Obviously, you will have a duration of the portfolio, and this is in terms of returns. Okay. So first of all, we understand why there are 4 tables. So these two should be looked together.
Yeah.
These two should be looked together. क्योंकि ये इसके रेफरेंस में, वो उसके रेफरेंस में. अच्छा, चलो अब देखते हैं क्या क्या दिखता है हमें. Can I say that with respect to benchmark, this is 56%, this is 40%. So basically this is somehow underweight.
Yeah.
उसने क्या किया है, शॉर्ट टर्म को अंडरवेट किया है, एंड मीडियम टर्म को ओवरवेट किया है. एक तो ये एनालिसिस हमारी हुई. अच्छा, बिफोर मूविंग अहेड, क्या सोच सकते हैं इसके बारे में? उसने क्या उसके दिमाग में चल रहा होगा जो उसने उसको ओवरवेट किया, इसको अंडरवेट किया?
He believes that the rates will go down.
He believes that rates would go down. But did you see that I'm not really playing around with duration for now? Isn't this more to do with steepening and flattening of the curve?
Yeah.
Short term versus medium term?
Correct. You're not changing the duration, but for the same thing you are there.
Yeah. Okay, we'll see that. Okay, we'll just do the analysis. Let's just try to see what else can we see. So we can see that in the short term, उसने कुछ तो इसको अंडरवेट किया है, and medium term में इसको ओवरवेट किया है. ठीक है. एंड ऊपर उसने एक डिस्क्लेमर दिया था, ऑल दैट इज नॉट वेरी रेलेवेंट. उसने ये बोला है कि मेरे पास लॉन्ग टर्म कुछ भी नहीं है. तो उसने एक बोला था कि व्हेन आई एम डूइंग द decomposition exposure decomposition analysis, so I have whatever it short term it is 2 years or less to me, and medium term it is 2 years up to 8 years. I don't have anything for long term. ठीक है. So the only buckets that they created for short term and medium term. अच्छा, और देखते हैं इसमें और क्या दिखाई दे रहा है. यहाँ पे देखते हैं. Can you see here? अच्छा, पहले इसी को देख लेते हैं और क्या क्या दिखता है हमें. Can I see that the portfolio duration is 4.84 and the benchmark duration 3.85? ये कोइंसिडेंस है, ऐसा होना था.
He's overweight medium duration, right? So it'll be
exactly. अगर आप वेटेड एवरेज भी लोगे, एंड अगर आप मीडियम टर्म बॉन्ड्स को ओवरवेट करोगे, तो इसका मतलब ज्यादा वेट ज्यादा ड्यूरेशन को डाल रहे हो, तो थोड़ी ड्यूरेशन तो ऊपर होगी देन द बेंचमार्क. मेक सेंस?
Makes sense.
ओके, ऑलराइट. और क्या देख सकते हैं? व्हाट एल्स कैन वी सी? ऑलराइट, यहाँ पे देखते हैं. कैन यू आल्सो सी दैट कॉर्पोरेट्स have 65% while the benchmark has 45%? इसका मतलब कहीं ना कहीं in terms of corporates he was overweight.
Yeah, 65 versus 45, right?
Yeah. So benchmark has 45% weight while the portfolio 65% weight. So he is long, or basically he is overweight on corporates and he is underweight on govies. Right? And one more thing is, I'm also looking at this table only and just try to figure out if I can find out. Achha, हाँ, एक और thing that I could just see. Portfolio return is 2.42 versus, underperform किया है इसने. Can you see? So I think that would be my starting point. मतलब मेरा जो portfolio, whatever I have done, कुछ तो कहीं ना कहीं तो goof up हो गया, है ना? जो भी मेरे bets मैंने लिए, and then we'll talk about each and every bet. Whatever I did, the result is that it resulted me in a negative return. तो कुछ तो मैंने severely गलत किया है, ठीक है? What is my active return in this case?
Negative 0.14%.
Negative 0.14. So one thing is, I think the idea here is to explain why am I getting a negative active return. ठीक है? Again, I would not know exactly कैसे हुआ है. I would not know. But I can say a few things about whatever I could see from the table. ठीक है? One thing that I know is that my portfolio has underperformed my benchmark and hence the negative active return. But उस active return का क्या contribution हो सकता है? ठीक है? अब एक बात बताओ, when you see that the portfolio duration was 4.84 and this was 3.85, what do you think the manager would have thought in terms of duration?
The rates are increasing. Sorry, decreasing.
Sorry, come again.
Rates are decreasing. I mean,
no, not decreasing, but then it speculate to decrease. Right? In this, the manager speculate to decrease. Can I say that?
Yeah.
I'm saying this is not the final result. This is not the final. We'll talk about the final result. Okay, but this is what he has done so far. So just by looking at this, I'm just trying to think from a manager's perspective. So if I am believing that my portfolio duration is 4.84 versus my benchmark duration is 3.85. So when I'm increasing my duration, can I say that I am expecting that my yield curve should go down parallelly? What was the first point that we discussed in terms of duration? We said that if I believe that the yield curve is going to go down, then I will go long on a long-term bonds. Yes?
Yeah. Yeah. This I got. How do you know it's flattening?
Sorry, how do you know?
It's flattening.
No, it's not flattening.
Okay, it's just going down. Yeah, that I got.
Yeah, so I'm saying I believe that the interest rates, the yield curve will go down.
Yeah, clear.
And hence I am long. Again, मुझे नहीं पता वो down होगा या नहीं होगा. वो तो results बताएंगे. ठीक है ना? ये तो मैंने ये जो मेरा पूरा दिख रहा है, this has happened on 1st of Jan. Basically the beginning of the analysis. ठीक है? So my results is gonna tell me was my prediction right or not. But I believe that the yield curve is going to go down, and hence I am actually long on a medium term bonds. I'm overweighting, right?
Yeah.
Okay. Another takeaway is that I believe that the market is going to perform well, and hence I believe that the spread is going to narrow down, and hence I am overweight on corporates. Is that correct?
Yeah, that's correct.
Okay. And so one thing I talked about duration. Second thing I talked about the sector. And a result, I know that this is underperforming. Okay. Let's just see. Now, this was our initial construction. This was our initial construction. Let's just see the results. Let's just see the results. So it says the duration effect, right? The duration effect. Can you see that in terms of duration, right? That in duration, I got a positive return. What does that mean? It means that जो उसने सोचा था that the yield curve will go down, it actually went down. भाई जो मैंने सोच के implement किया, अगर return positive है, it means whatever I thought happened. Yes or no?
Yes.
So he was long on a medium-term bonds, and medium-term bond actually outperformed the short-term bonds. I was underweight short-term. It gave me negative return, and I was underweight that, so it was a good bet. In a medium-term bond, I was long on medium-term, and then it outperformed, so it's a right bet. Ultimately, I got this, which clearly means that in terms of duration, my speculation was right, and yield curve indeed, fall or fell. ठीक है? How about curve effect? So I'm saying here that I'm losing around 39 bips in curve effect. What did we see in curve? Look at this here. In a short, I was long on a medium term versus on the short term. So I thought that my yield curve is going to steepen. Is that correct?
It's going to flatten, right?
Sorry.
It will flatten, right? Because you believe that the medium term things are the rates are going to fall.
Yeah, exactly. You're right. So it actually steepen nahi hua.
Yeah.
Right? Which means the bet that he took upon got incorrect, and hence you get a negative return.
So it actually steepened.
Sorry?
No, he was betting it would flatten, right?
He was betting, look at this. In this, okay, when you underweight your short term and you overweight your medium term, what your expectation is? That it is going to flatten.
Yes.
Right? But it actually steepened.
It actually steepened, correct.
Because, and why am I saying this? Because you're getting a negative effect. I'm concluding this.
Yes.
From my negative return. क्योंकि अगर जो मैंने सोचा अगर वैसा हुआ होता तो positive return आता.
Yeah.
Does it make sense?
Makes sense.
Okay. How about total interest rate allocation? Something that I can't really take care of. Okay. I would not know how my interest rate allocation would work because I don't really control this part. Look at this sector allocation. We did corporate versus government. ठीक है ना? So we thought that my the spread is going to reduce. That's the reason I was overweight in corporates and underweight in government.
Yeah.
Even that bet got wrong. ठीक है? इसका मतलब ये होता है कि जो spread है वो widen हुआ है. ठीक है? And bond selection was 0. So first of all, I did not really derive any of these numbers. They will be given to me.
Yeah.
But just by looking at my portfolio construction, I can imagine what manager would have thought of. And hence, how has he overweight or underweight things? And then what is the overall impact, which means did his bet got right or wrong, is something that I can analyze. Does it make sense?
It does.
Okay. Let's just quickly review so that we'll be sure and we can proceed then. Let's just see if we have covered everything. So it says the total portfolio return was 2.42. Okay. And benchmark was 2.56. Underperformance was minus 0.14. Okay. We are clear on that?
Yes.
They said the overall portfolio duration was 4.84. 4.84, right? And then it said that the overall benchmark duration was 3.85. Can you see that?
Yeah.
This implies that portfolio would outperform if the yield curve experience a parallel shift down. We talked about it. Would outperform basically means we are speculating for now. Okay, so that's my manager's idea while getting a higher duration for our medium-term bonds. And then lastly, the manager was overweight in corporates. It means then the benchmark, it means the manager expects the corporate spread to narrow. See, again, that was my expectation, that my spread would narrow, which means the corporate bonds are going to outperform the government bonds.
Yeah.
Are we good?
Yeah, good.
Okay. But effectively, what has happened? The higher active duration of this, it means it shows the outperformance, which we just discussed. It means that the yield curve did indeed fall. Okay. 39 bips that was lost. We talked about this. This implies the steepening of the yield curve. And 8 bips that were lost, it means it is evidenced by the lower returns in the benchmark for corporates than the government bonds. So basically it says the corporate bonds spread widened, right? While we thought that it's going to go narrow, and obviously it did not take any active bets on the bond selection. So everything was zero. Are we okay?
We are okay.
Okay. So this takes some time to absorb, but then once you know it, you know how to think in, or again, as I said, the only thing that they can play around with either the duration or the curve or the sector or the bond selection. Okay. So
Yeah.
when you know that you have to decompose your portfolio in these 4 terms, so when you get a question, so you will know that, okay, I need to look for these things. So you will start finding the differences between portfolio and the benchmark, and that would be your starting point on what manager would have thought. And the good thing about this is the only thing that could be asked in these kind of questions. So if you know the basic rule of when I am going to increase my duration versus decrease my duration, what is the rule of steepening versus flattening, how govies and corporate works, you're done with this kind of question. You will never go wrong. Okay, are we okay with this?
Yeah.
Okay. Another one is this one is even simpler. Another one that we talked about is yield curve decomposition. There we were decomposing the duration, and here I'm just decomposing the yield curve. Okay. So from the yield curve, what all can I get? The total return can be sourced from first the yield, or let's say income, by obviously the coupon payment. Coupon payment is a kind of income.
Yeah.
The roll yield, somewhere in your CFA level 3 itself, in fixed income, somewhere they teach about the different strategies of earning the return. So there is something called as ride the yield curve. Okay. Ride the yield curve basically means that you go long. If the yield curve is upward sloping, so you basically go long the long-term bonds. And why is that so? Because when that time comes in, right, your prices will roll over to that value. Ultimately, it's going to reach at par. Right? So basically, long story short, I can tell you, you can see that higher yield basically means higher return. You can call it that way. Whether it is illiquidity premium or something else, or risk premium, वो सब fixed income में detail में पढ़ सकते हैं. But the idea here is that you are riding the yield curve. You are trying to get a longer duration bond so that you can earn more yield. Is that okay?
Yeah.
Okay. Third is the shift. Basically, the parallel upward movement or downward movement. The way we speculate, we can earn. Again, shape, we talked about this, the steepening or the flattening of the curve, right? The spread, which we said, okay, maybe the spread between two securities, underweight versus overweight of the undervalued and overvalued security, or versus corporates versus govies, the spread that you can earn, right? Or maybe they call it as one more, which is not so important, but then they call it as a residual. So basically they call it as the unexplained movements. Kind of a plug-in factor. So basically they say that in the previous one, we were trying to decompose my duration in terms of short term, medium term, long term. And then I can say that, okay, I am getting more return because I took active bets on A, B, C, D, E, different factors. But in terms of total return, it just says that because my idea is to understand from where my return is coming from, right? So if I can decompose my total return itself, I would know is my maximum driver my coupon payments, or when I'm rolling over my different maturities, or maybe it is because of the parallel movement of the yield curve, maybe it is the shape, or maybe it is a spread on how I'm taking it. And then accordingly, by the way, why am I doing all of these exercises?
You want to figure out whether the manager has done what he said, where he's generating alpha.
True, true. Another reason is if I know that 90% of my return is coming from coupon payment. So basically my focus would be to get a higher coupon payment bonds. That's about it. But the whole idea of attribution is that if for a manager selection, it's great. For a manager selection, it's great so that I would know कि जो manager बोल रहा है वो कर रहा है या नहीं कर रहा है. I understand that part.
Yeah.
But don't you think that the major reason of doing the whole of attribution, whether it is equities or fixed income, is to identify the different reasons of the outperformance or the underperformance, so that whatever factoring is working for us, whatever factors are working for us, we can focus on those factors and get more return consistently.
Yeah.
And that was the main reason of performance appraisal, where we would want to know if it is coming from luck or from your skill set. Because if it is coming from luck, then I don't know if am I going to get that in future or not. But if it is coming from your skill set, which you can define or explain, then really, yes, I know that I can get that consistently year over year because that's your skill set and it is working for you. Right? So again, in this case, when I'm segregating my whole return, and if I know that my 90% of my return is coming from coupon payments, so all I need to concern about is how much coupon am I getting. So if I can get a good coupon bonds, then that will constitute my overall return. Okay? Is that clear?
It's clear.
Okay. And the last one in this is this is yield curve decomposition, but that's a full repricing. अच्छा ये क्या चीज है? ठीक है, इसमें क्या होता है? By the way, you will not get any question on this. They say that this is fairly complicated. It requires complex methodologies and will not be used. Obviously, it gives you, this is the most exact way of doing things and will result in it comes in with the maximum accuracy. But then again, despite that, people don't use it because it's very complicated and it's difficult. And the question is, why is it difficult? Because what it says is that let's say you have a 5-year bond, right? 5-year bond has semi-annual payments. So let's say you have 10 payments for 5 years. You get first payment. What it does is this first payment constitutes some return. When you get your first coupon payment, that's some part of your return, right? We just discussed in a yield curve decomposition that coupon payment is one of the yield or one of the income that you consider. So what it does is it looks at the spot rate at that time, right? And the prevailing interest rate. So it looks at the current spot rate at that time, and then it compares your income and compare, did you really do well with respect to the overall market or not? And it does the same thing for every coupon that you get, not the overall, but here, and then it looks at the spot rate curve at here, this one, because every time the spot is going to change while your coupon is fixed. So 10 data points, 10 coupon payments represents your 10 individual portfolio that are being compared to the spot market yield curve at that time.
Okay.
Right? Because think about this, if it is a 10-year, 5-year bond, in 5 years, the market can change a lot. Right? While your coupon is fixed. And in most of the situations, if you remember, when we calculate NPV, we take the I as constant, right?
We take I as constant. We do.
Yeah. But do you think that it is constant for every duration? No. No, they're not. Right? Although this is a good approximation, ऐसा नहीं बोल रहा हूँ कि जो calculation थी वो गलत होती है. Because let me tell you, this I, the interest rate that we get here, is also based on the spot curve. Right? And again, I have taught so many batches, so I don't even remember if it is a part of your CFA level 2 or level 3. I clearly don't remember, but you can tell me, because probably you would not even remember because you did it in 2019. But they give you so there is a way that you looked at the spot rate curve, and then you do a kind of a you do a bootstrapping. Okay? So you looked at the spot rate curve, and then you do the bootstrapping, and then you arrive at one single number that will be used throughout. Okay? So the point I'm saying is that this is not some random interest rate. This is also a good approximation, but it's just an approximation. But the interest rate for every single time, it is going to vary, because the spot rate is going to change with respect to the market and the expectations. Right? So the idea that I'm trying to give over here is that why this is very complicated is because it assumes every payment as a single portfolio, and it says, okay, how my overall spot works, how much return can I get from that spot based on the current market conditions versus how much I got, and did I do well or not, and that it tells me that did I outperform or not, and hence my active return. So that becomes a very complicated process. Okay? Are we good? Are you finding this topic difficult?
Yeah, this one was a bit difficult. This last part.
Okay. Okay, but you're not going to get any question on full repricing, so don't worry about that. All right. So we talked about fixed income returns.
Just give me 30 seconds. Yeah, getting water.
Yeah. Sure.
Yeah.
Okay. So it says, so far we have studied about fixed income returns, but obviously we understand that it's half analysis unless we study risk. Right. So it's important, and they say that everybody talks about return attribution, but return attribution is incomplete without the risk attribution. And it is important because how much ever we take the risk, we get the appropriate return, right? So it is important that we understand how are we taking that risk. Now in fixed income, they talk about 2-3 different things. One thing is, has the manager took a top-down approach or a bottom-up approach? Or maybe the manager has taken a factor-based approach. Right? And also, it is important to understand, has the manager taken risk with respect to something. Basically, I can say it's a relative, or maybe it's an absolute. I can say that my benchmark is X, and then with respect to that, I'm taking my active bets. Basically, I'm taking active risk. Versus, I can say that it is all about me handling my portfolio independently while I'm not benchmarking on reference anything else. Right? Okay. Another thing is, when they say it's a relative, well, in fact, let's look at the table here rather than me writing it down. We can understand from this one. Right? It says, if it is a, let's talk about absolute first. Look at this in terms of absolute, and you would see this very often. Every time you talk about absolute, they talk about total risk. Versus every time you talk about relative, it's tracking risk. Why is that so?
Because absolute, I mean, relative is you are tracking to the benchmark, so you want to see how much alpha you're making. Total risk is just absolute.
Exactly. So whenever you talk about benchmark, whenever you talk about relative, it has to be with respect to some reference, which means how much you are digressing from the benchmark, and hence how much you are tracking, and how much you're not tracking. That's a tracking error or the tracking risk. Versus absolute, you are whatever risk that you're taking, that's the total risk that you're taking. Right? Now it says bottom up. Again, you can look at this. The name itself explains, if you are doing a bottom up, then you are looking at a security level. Anything that is bottom up, has to do more with the end thing is the security, the stock. If it is a top down, maybe you can talk about different geographies, then different sectors or whatnot. That's a top down. But at the end of the day, you will boil down to the security level, right? So it says when you are looking at a bottom up, you are looking at each and every security, how much that security is different from the benchmark security. Okay?
Yeah.
And how much it is tracking. Hence the tracking error. And then obviously this one represents the overall marginal contribution to a total risk. Okay? When it comes to top down, in this one, it says I'm gonna track, there's a tracking error relative to selection or allocation. Again, in a top down, I'm not looking at a security level, rather I'm looking at a overall broad spectrum, could be sector, could be anything else.
Yeah.
The name explains top down. When it comes to factor, obviously you can say that on a specific factor, how much I tracking. Right, so it's a marginal contribution to tracking error, obviously with respect to any factor that you use in the benchmark. And again, in this one, this is absolute. Is that okay? Right? So can I say that my absolute risk is, can I say that it could be sigma, the standard deviation?
Yes. Yes.
In terms of absolute, we looked at the portfolio returns itself, and then we calculate the sigma. That's my absolute. Right? And in my relative terms, it's a tracking error, which is basically with respect to the benchmark, how much are we digressing? Okay? Are we clear on that?
Yeah.
Okay. Although we just discussed this, everything, but let's just quickly mark a few things here. The general objective is to determine the returns generated from the active management and compare them to the amount of tracking risk assumed. Okay?
Yeah.
In a bottom up, each security has a marginal contribution to the total risk. Obviously, you are looking at a security level and how much do they digress from the benchmark. Every security has a marginal contribution to that risk. Right? जितना भी दूर जाओगे अपने benchmark से, उतना ज़्यादा वो contribute कर रहा है अपने tracking risk की तरफ. And then that amount is multiplied by the active weight to determine the contribution to tracking risk. ठीक है? You are multiplying it with the active weight. Basically, that's how you are doing this is how you are digressing, right? Where two securities A and B, when you are overweighting and underweighting. So depending upon the active weight that you have, that much contribution you are doing to the tracking risk. Okay? And then it says it does the same in terms of top down. It's just that you are doing it at a broad level, but not at a security selection level. Okay? All right. Simple thing. Let's just solve at least one question. I would not ask you to solve this question because that's a fairly simple question. Okay? Wapis say you just need to use the three different formulas. The selection effect, allocation effect, interaction effect. Okay, it's like plug and play. Okay. Let's just look at this. थोड़ा सा try करने लायक question. I'm just trying to minimize this one level so that you can see the question in one go. Is it visible, or do you want me to scroll down here and there?
No.
Can you manage? Okay. Let's just try this question. Let me tell you one thing. एक काम करो, just take a photo. Because there are questions beneath, so you will need to keep scrolling up and down, so you can refer from your phone, and then there are questions beneath. Taken?
1 second.
Okay. And then, especially this one, is it visible right on your phone?
It's visible.
Okay. Okay. Let's try these 3 questions. Take 5 max. Is it easy, difficult?
Yeah, easy.
Okay. Are we done?
Yeah.
Okay, let's discuss. How about second one?
Second one, that's C.
Okay, and how did you arrive at C?
I did WP minus WB.
Sorry?
I did WP, weight of portfolio, minus WB. For capital goods, it is negative 1%. Multiplied by the return of the benchmark minus the total benchmark.
Okay.
Hello?
Yeah, I can hear you very well. Yes, I'm listening.
Yeah, so negative into negative gives you positive, so he's done well in the capital goods sector.
Okay, good. But the question is that I know you could have done this easily, but yet I want you to solve this question. So here's the catch. I totally agree. You can always calculate and the numbers are all given. But let's just look at this. You know the whole story, and then it says, does Matson demonstrate an ability to wise allocate funds to capital goods and or financial sectors? So let's just talk about capital goods for now. If I look at capital goods, benchmark has given you minus 5%, and the overall benchmark has given you 0.86. So this capital good sector has underperformed the overall benchmark.
Yeah.
So should you overweight or underweight our underperforming benchmark? Underperforming sector, sorry. Let me repeat.
You should underweight.
Underweight, right? Well, should I repeat?
No.
Okay. So we believe that since capital goods benchmark itself is minus 5, while the portfolio has given me 0.86. So this sector has underperformed the overall benchmark return. So we should underweight a underperforming sector. Is that correct? Are we underweighting?
Yeah.
So it will give me a positive return.
Yeah.
How about financial sector? So this financial sector, this has the sector return has outperformed the overall benchmark.
Yeah.
So effectively, we should overweight an outperforming sector.
Yeah.
Are we overweighting?
Yes.
बस तो हो गया काम कुछ खत्म. ठीक है?
Yep.
Did you see that we didn't do any calculation here?
Yeah.
Okay. How about question number 3? What is the answer?
3 is B.
Okay. And how did we arrive at?
We just had to figure out whether portfolio return was
stock. Okay.
Portfolio return was higher than the benchmark return.
But this was at a sector level. This is a stock level. Okay, let's see. Ability to stock select consumer staples की बात करते हैं. Consumer durables की. Consumable durables में portfolio return 2% है and benchmark 3% है. ठीक है? By the way, I hope you know that we would not be considering 0.86 anywhere when it comes to security selection, right?
Yes.
Okay. तो इसमें पोर्टफोलियो ने अच्छा परफॉर्म नहीं किया एंड बेंचमार्क ने अच्छा परफॉर्म किया है. हाउ वुड यू थिंक सिमिलरली टू अंडरस्टैंड इफ what could be the right answer? Basically, I'm saying you can always do the calculation which you have done it already and you arrive at the right answer. Okay, I believe B is the right answer. I don't deny. But the way we thought about without solving it, how can you go about doing it?
And no, you just have to figure out that if your portfolio return is higher than your benchmark return.
Okay. And if it is, then you go long.
Then you're.
And if you overweight that thing.
No, it doesn't matter. Weighting doesn't matter. Weightage doesn't matter.
Then how would you take a call?
No, it's on selection. It's not. It's not on allocation. So weights don't matter.
Correct. No, wait. No, you are saying. Which one are you saying? Selection, security selection, or sectors?
I'm talking about security selection.
In security selection, you are saying weight doesn't matter.
Yeah.
Okay. So you're saying, obviously, right? So you're saying 35% would be, and then you are looking at returns.
Yes.
Okay, perfect. So in this one, you can see the consumer durables is not performing good.
Correct. So selection.
While technology does. Right? So technology would be the right answer, which means B is the right answer.
Yeah.
Okay, how about the fourth one?
Fourth one is B. I don't know how to do it quick, but you just look at the difference in weights and the difference in returns.
But ideally, I would say it is not easy to interpret fourth question easily just by looking at it. So the best that you solve it.
Got it.
ठीक है, क्योंकि क्या है वो इतना अच्छा, obviously you can do it if you think that much कि वो weight negative कहाँ हो रहा है and return positive negative कहाँ हो रहा है and then उनका summation positive है कि negative है, obviously you can do it. But it's good if it comes to interaction, just solve the question. These two can be just looked at from the table and get the answer right. Are we okay?
Yeah.
Good to proceed?
Yes.
Now to say that there are two types of benchmarks. Two types of benchmarks. One is asset based. Another one is liability based. Okay. So the liability based benchmarks is just one of a kind, and we don't do much. So let's just discuss this first, and then we'll go in detail for the asset based. The name explains liability based. So these benchmarks are the major objective of to use the liability based benchmark is to fulfill a liability. Okay. What that liability could be? One of the premium places where these liability based benchmarks are used in, let's say, pension fund. Kyunki, if you know, these pension funds, these insurance companies, right? The idea here is that they are not there to earn more money, but just to meet the liability. Just to meet the liability. And in your CFA level 3, you are going to study somewhere in the whole topic about these pension funds, about the fund status.
Yeah, I've read this topic.
Okay, you read it already, right? So you know if the assets is more than present value of liabilities,
surplus.
In that case, sorry, it's a fund surplus. Yes.
Yeah.
Okay. And then since the market is very competitive, पहले तो क्या होता था? Initially, all these insurance companies, all of these, they have a mandate that they will have to invest around 90% only in fixed income.
Yeah.
They have a mandate. But since the competition is too high, so they said that, okay, let's just digress, let's say 10 to 15%, and then invest the 10 to 15% in some risky things.
Yeah.
Right. But then the moment they realize that the interest rates or things have gone too far and then they could make a loss, they immunize it immediately. Right. Because that was never their objective to earn the money. Okay. So liability based benchmarks are mainly for defined benefit plan, etc., pension funds plans, where you want to just meet the liability and not really care about the return. Right? They say that what are the different features of that? Okay, of your liability based benchmarks. So one thing that they say is that what is the how many years? In fact, let's just look at this rather than I type everything and then I'll show you. Look at this. Your liability based benchmarks has some features on how many years until the average age of workers will retire in the plan. Now, how does this matter? How does this matter? If my average age of worker is, let's say, 30 years, so it is important that my liability based benchmark should start giving me returns, or I should have liquid money in 30 years, versus if my average age is 50 years, then I can invest into some long-term investment so that I get my return in the 50 years.
Yeah.
Right. So this matters a lot, what my average of workers is. Okay. Second, how many workers have already retired and are drawing cash from the plan? Because जो भी ये amount रहेगा, this comes in as a coupon payments, right? तो जितना भी वो हर समय pension का amount जा रहा है, it should get met with the ongoing coupon that you are receiving from those investments. ठीक है? The impact of inflation on the liabilities, you can clearly know inflation change होगा, मतलब interest rate change होगा. Interest rate change होगा, तो present value of liability is going to change big time, and then it's going to change your fund status.
Yeah.
Right. The correlation between companies EBIT and the plan assets. Again, you said plan assets as in you have assets and then you calculate the present value of liabilities and then you decide what's my fund status, if it is overvalued or undervalued. But think about this. Let's say you realize that the fund is undervalued, or basically it is a deficit and you need to put in more money. And that's the time you realize that company itself is not performing good. Right? So it is important that we look at the correlation between the EBIT and the plan assets, so that I would know that if companies is not performing well, so when I have less assets and I would want to put more assets, I don't have money if the correlation is high. Does it make sense?
This one, last point, can you repeat the if the correlation
This
is
EBIT
high,
and plan assets?
What?
Which one do you want me to repeat for EBIT and plan assets?
Yes.
So I'm saying, so EBIT is basically company's profit.
Yeah.
Plan assets as in the fund status plan thing, the asset thing.
Yes.
Let's say I'm saying that the fund status is negative. Basically, your present value of liabilities is more than the assets. Right? So the mandate is that you refill it with extra money.
Yes.
Right? That's the idea.
Correct.
Now, what I'm saying is the correlation between those assets and the company has a high correlation. In that case, when the asset value reduces, which will want you to put in more money in the fund, that's the time when your company will not have funds, because they're correlated.
If EBIT is correlated.
If it is correlated.
Right.
Correlated as in the positively correlated.
Understood.
ठीक है ना, मतलब जिस समय पैसे की जरूरत है उस टाइम ही पैसा नहीं है. ठीक है ना, because they're highly correlated. Again, if the plan is frozen or has a terminal life, again we will also need to see if it is a perpetual plan or does it have a terminal life. Accordingly, we can invest our things accordingly. And any actuarial assumption, including the life expectancy and required discount rate for the plan. So basically, this is more about that there could be in between cash. Do you know about VRS? VRS, voluntary retirement scheme.
No. Yeah.
Okay.
No, I don't know.
So basically, all the government employees जो कि pension के लिए eligible होते हैं.
Yeah.
ठीक है ना? So they give you this scheme that you take a voluntary retirement. When you take voluntary retirement, you will not be eligible to get the pension. But whatever pension that you get, there's a big calculation in terms of VRS and how do they calculate that number with. But the idea is that they say that if you are if you are, let's say, 45, and you would have worked till 60, so 15 years here, and then if the life expectancy is 85, so 25 years of pension. So 15 years of working and 25 years of pension, right? So when you work from 45 to 60, you will get some salary hike, right? Are you following what I'm saying?
Yeah.
So from 45 to 60, you will get some salary hike. On 60th, whatever your last salary would be, your pension will decide on that last salary.
Okay.
And then you will have 25 years of that pension. So I'm going to put some assumptions in terms of hike, in terms of interest rate, in terms of your pension be.
I see.
And then they discount it back to the present value. And then they give you a lump sum amount at 45, and then you take a VRS. Right?
Oh.
Now, if a person takes a VRS, right, the company has to give him that much cash. It means he will have to redeem that much amount.
Yeah.
Which he never thought that he would. So it says that also these things also make some differences. And it is important that because either don't have such kind of schemes. Either because if you have a scheme, people can avail.
Yeah.
So either don't have such kind of schemes, but if you have such kind of schemes, then you should assume that one or two people could go for it. So you should also think about putting some money in some liquid instruments, so that just in case you have such kind of a scenario of a VRS, you can cash in that money and give it to that person.
Correct.
Is it clear? These are different features that could, and again, I'm sure about this, that it is not in this, but it could be in somewhere else, that you will get a question on pension funds.
Yeah.
100%, because I'm confident, because even I got that question.
Yeah.
Okay, so on the features, you are 100% going to get a question. वो उसमें जो मैंने भी explain किया वो भी एक feature आएगा उसमें, और interest rate, discount rate, inflation, ये सब features के ऊपर how my overall plan fund status would change, would bring in question something around that on those lines. ठीक है?
Makes sense.
Okay, so this is liability based. This is done. Let's just talk about asset based. So the way they explain the asset based benchmarks, they say that there are 7 type of benchmarks. 7 types of benchmark. And in your curriculum, they then explains later of what can be an ideal benchmark. Okay, but I go the other way around. I first explain you what should be the features of an ideal benchmark, and then we'll talk about the 7 type of benchmarks. Okay. So I would say, when it comes to benchmark, how would you decide if I should use that benchmark or not? But I can, let's say I can explain you that you can have a custom benchmark. This is one of the type. Okay. Custom benchmark basically means, again, the name explains, it is custom. Okay. And then I'll say the best feature about this is that it could be customized, then the managers can relate to that, etc. Whatever. But the idea is, does it satisfy the condition to become a benchmark? No.
Because it's not investable.
Investable. Yeah, you got it right? So it is important to understand what are the different features to become the benchmark, and then we talk about those 7 benchmarks. Okay. So first feature is, whatever benchmark that you're going to choose, it should be specified in advance. Very, very important. Very, very important. Why? Because then only the investor would know that if this is your benchmark, which you told me at the beginning of the period, how your portfolio has performed with respect to the benchmark. Otherwise, वो बाद में जाके बोलेगा, अरे मेरा benchmark तो ये नहीं ये था, जहां पे भी outperform किया होगा, it doesn't make sense.
Yeah.
Right? So it should be specified in the advance. Second is appropriate. Now, what does appropriate means? If I know that my manager has expertise in selecting the small cap securities, then it is important that I choose a benchmark, let's say S&P 400. 400 or 600 is small cap. Let's say 400. I don't remember. I think 600 is mid cap.
Right.
500 is large cap. Okay. So if I believe that my manager has a view or has an expertise on a small cap, and I use S&P 500 as a benchmark, then that's not appropriate. Okay. So appropriate benchmark is the one which qualify my manager's style and approach. Third,
qualifies what? Manager's style.
Qualifies the manager's investment style and approach. Okay? Whether it is small cap, whether it is large cap, whether it is value, growth, whatever it is. So I would want to have an appropriate benchmark so that I can calculate later whether it outperformed or underperformed.
Yeah.
Make sense?
Makes sense.
Measurable. Right? It means that I should be able to calculate the benchmark's value or the returns on frequently basis. I'm not defining monthly, daily, weekly, annually, but I'm saying that whenever I want, I should be able to measure of how my benchmark has performed versus how my portfolio has performed.
Yeah.
Okay. Fourth is it should be unambiguous. Unambiguous, which means the weights of those securities should be clearly defined. Matlab, it's like this. If you have a Nifty 50, you can open that Nifty 50 composition any day and you can see that which security is in Nifty 50 and what is its current weight and what was its weight previously, what is the price. It should be unambiguous.
Yeah.
Okay. Fifth one, it says it should be reflective of managers' investment opinion. It is in line with appropriate.
Yeah.
Which means it should reflect my manager's opinion that yes, whatever it's been happening in the benchmark is what I'm trying to build upon, but with a different view of overweighting and underweighting and whatnot. Should be in line, but okay. Next is accountable. Okay. The manager should be held accountable for that benchmark, and manager should say that okay, this is the benchmark that I'm going to bet upon, and I'm going to make some active bets, and this will be my reference. ठीक है, तो मतलब the manager should be held accountable that if my active return is negative, then he should believe that whatever negative return that he got is only because of his drama and not because of anything else. So, मतलब he should be held accountable for whatever he is doing with respect to the benchmark, and then he should accept those changes. Changes as in the positive or the negative return that you get from the portfolio. Is that okay?
Yeah.
And lastly, very, very important, investable. Investable. It clearly means that the portfolio, sorry, the investor should have the capability to forego the portfolio manager style and should be able to invest in that portfolio itself or the benchmark itself. So what I'm saying is, let's say my manager has a portfolio P and he is betting against S&P 500. And I saw that every single year he is underperforming.
Yeah.
Then I should have ability to cancel all my transactions here and straight away invest in S&P 500.
Cancel the transaction with the manager and then straight away invest in the benchmark.
मतलब मुझे पोर्टफोलियो मैनेजर के पास फिर जाना ही नहीं है, मैं पैसिवली इसमें इन्वेस्ट कर सकता हूँ.
करेक्ट.
ठीक है. एंड मतलब आई कांट what is the right word here? I can't emphasize more on how much this factor is important. I have spent a lot of time in fixed income, and one of the key things that we talked about, because we were kind of a benchmark providers, so one of the biggest reason was investability. So we always had this in mind that if I'm going to make my benchmark too concentrated or add bonds that are illiquid, then replicability could be the issue, or we call that as an investability. So investability constraint is one of the most important constraint that we should look at. That if nothing works out, the investor should have a right to go ahead and invest in that specific benchmark itself. Okay, are we clear on that?
Yeah.
Okay. Now let's just start with 7. They are small ones, would not take much time. So I would not maybe complete 7, but let's just start since we have some time.
Yeah.
So one of the things is they say it's absolute benchmark. Okay. The name explains. The name explains. So basically they say that there is a minimum target return.
Yes.
And the objective is to exceed this minimum return. Right, that's objective. Advantage, simple, straightforward. Right? Disadvantage, can you invest into minimum target return?
No.
But disadvantages, it's not investable.
For advantage, what did you write? Simple and?
Simple, straightforward.
Straightforward.
Straightforward. I can just simply say that, okay, let's just my benchmark is 5%. Yeah. I want you to be, and this is how we usually say, right? Even to me, if someone is going to ask me that, Ankur, I have a portfolio, do you would like to invest into? I would say, look, I want anything more than 15%. You give me 15%, more than 15%, I'll invest my money. Okay? So 15% will be treated as my benchmark. You beat the benchmark, I'm okay to invest. But how will I invest in 15% itself? It's not investable. But now, can you see it now makes sense to understand what a non-investable means?
Yes.
So I think CFA should shuffle these two topics somewhere, I believe.
I see.
Okay. Another one is, the second one is broad market index. You can imagine, right? S&P 500, Nifty 50. Needless to say, right? They are well recognized. Obviously, they are unambiguous. They are investable. So whatever features that you saw in how a benchmark should be, right? It is broad market index. The only problem with this is that manager style could be, think about this, right? S&P 500, 400, 600, whatever the broad market indexes are, they are pretty much just market weighted index. I hope you understand what the market weighted index is.
Yeah, no, I understand.
Right? So basically you do a P into Q.
Yeah.
Price into number of shares. And then you take the weight.
Is S&P 500 also market based or that's price weighted?
No, market based. 100%. So S&P 500, 400, 600, they're all market cap based. The only price weighted, it's not even price weighted. I think equal weighted is, I think, Dow Jones. Okay. Dow Jones is price weighted or equal weighted, I should price weighted. I don't remember now. Okay. But S&P 500, Nifty 50, 100% sure. Okay. So the point here is that my manager style, it is not necessary that my manager style would always be a standard market cap based index, right? So if his style, when I said measurable in a way, measurable, you can't say that your manager's view is in line with the broad market based index. So in that perspective, it has a disadvantage, but otherwise it has all the advantages to become the right benchmark. Okay. Last one, and then we'll wrap it up, is the style index. Right? The name explains that your style, let's say small cap index, right? A small cap index is a style which is again investable, which is again measurable, and could be in line with the manager's view, right? So it represents a good benchmark. Okay? But the only thing is in style that sometimes in a small, let's say small cap index, you overweight some of the securities or some of the sectors, which is way too much than the manager would assume. Right? Then in that case, it could be one of the disadvantages that it might not reflect exactly my manager's style.
Yeah.
Okay? So that could be one of the reasons of why this might not be the right benchmark, but otherwise, again, it's a good benchmark.
Got it.
Okay? So another one coming up is factor based, and then you have return based. Then we'll talk about managers universe. This is very interesting. And the last one was custom. So we'll start off with, sorry, custom. Yeah. मैं वो एक्सप्लेन कर रहा था ना स्टार्ट करने से पहले बेंचमार्क्स के बारे में कि कस्टम बेंचमार्क कुछ भी बना लो, ठीक है? But this is interesting that I like, but we'll talk about all four and then we'll take it from there.
Okay.
ठीक है? So the next class will be on Tuesday.
Yeah.
And the plan is Tuesday, Wednesday, Thursday, and then Saturday.
Next Saturday I won't be able to make it. It's a bit of a challenge, but let me get back.
Okay. So if that's okay, then we can do either Friday or we can do Sunday.
Correct.
Okay. So we'll plan it out the next week itself. But then I think if it is going to be either Friday or Saturday or Sunday, that would be your last class.
Yeah.
Okay. So we will just try a few different questions there, and we'll see if we have understood everything correctly.
Perfect. Do you think we'll be able to cover fixed income or tough?
Fixed income, though I doubt, but I can. If this finishes off quickly,
take it.
The next topic is very theoretical, so I'll try to wrap it up. I'll see if I can devote at least one class to fixed income so that I can give you some basics of it.
Thank you.
Okay, but we'll see because I have one more topic which is asset real world thing, right?
Okay.
That needs to be covered.
Okay.
So we'll see how that goes.
Okay.
And if wherever I'm going, if you think that that's something that you understand and you know it, you can just tell me so that we can move on quickly.
Yeah. Makes sense. Okay.
Sure. All right, then I'll see you on Tuesday.